Having a great entry is one thing, but knowing when to jump off a trade is another thing entirely. These are the 3 common mistakes that beginner traders make. Number 1, closing your trades too early. Number 2, closing your trades too late. Number 3, giving profits all back to the charts. Make sure to watch this video to the end, because at the end of this video, I'll give you 4 tips on how you can fix this problem. And also, don't forget to subscribe and like. Number 1 problem, like we said, is closing your trades too early. The reason a lot of traders close too early is simply because of the fear of losing the small profits that they have already made. A trader takes a trade and is probably in a profit of 1:0.5 RR. Let's take for instance that this trader was willing to risk $8 on this trade. That means he's up currently in profit of about 0.5 cents, and for fear of losing that 0.5 cents, he closes the trade. The major problem with this kind of trading is that you tend to leave a lot of profit on the table, and the reason is simply because you do not have a solid trading plan. Also, this style of trading has a way of not just negatively impacting your trading, but your psychology. Number 2 problem, closing your trades too late. The reason a lot of traders close too late is mostly because of greed. Now, greed can be a major problem when it comes to trading, and we cannot completely eradicate this greed, but we can try to manage it. In this scenario, price has significantly gone in their direction, and for some reason they choose to still hold on blindly to the trade, and so do not manage their trade properly. What ends up happening in some cases is that they either lose all these profits back to the charts, or they close out at a much lower profit, which they consider to be insignificant. This style of trading also has a way of negatively impacting your trading and also your psychology. Number 3 problem, giving your profits all back to the charts. In this scenario, not only did the trader close his trade at a much lower take profit, he closed his trade at a loss. Sometimes with price even going back down to their stop loss level. You see, it's one thing to be in a profit and then all of a sudden not just lose the profits, but also end up at a significant loss. I mean, if you think about it, that's really crazy. All these mistakes can be avoided if you start to apply these 4 tips. Tip number 1, mark out your first take profit zone. Now, this zone should be the very first zone that you know price would most likely react from. It is also important to note that your first take profit level should, as much as possible, have a minimum risk to reward of 1:1. Meaning to say, if you're willing to risk $8 on a trade, your first take profit level should be a minimum of $1 or even more. The more, the better. Tip number 2, mark out your other zones of likely reversals. These zones would act as your next profit targets once price is able to break through the very first zone. It's as simple as that. Tip number 3, trail your stops. In other words, do not always close your trades immediately. Even if you have to, only close partials and let the other run while your stop loss levels are adjusted as each zones are violated. Now, the reason for this is so that you can make the most of every winning trade. Tip number 4, look out for an invalidation candle or pattern. In other words, be on the lookout for any candle formation or patterns that might suggest to you that the current direction has been violated and a possible reversal is about to occur. At this point is where you can now close all your remaining trades, because you know that price is most likely to experience a reversal. When you learn to manage your trades in this manner, then you'll be able to avoid these 3 mistakes: closing your trades too early, closing your trades too late, or even giving all your profits back to the charts. Now remember, trading is not emotional, trading is discipline.